The U.S. economy is looking more positive as 2011 comes to a close. The Conference Board said yesterday that consumer confidence rose to its highest level since April, so that's an 8-month high. Can we expect more upside momentum in 2012? Joining us now from Barclays Capital in New York is Bloomberg Best Dean Maki. Dean is Barclays' chief U.S. economist. Dean, good morning to you.
Good morning.
So we've had a day to digest this Conference Board Consumer Confidence Index, and it kind of backs up what we've heard from the University of Michigan and other confidence measures that people are feeling a little bit better here. Is it optimism across the board? I mean, where do you see this positivity reflected the most?
Well, I think what's happening is people are seeing some progress in the job market, and that really is critical to confidence. The unemployment rate is now at its lowest level since the recession started, and we are seeing jobless claims fall to their lowest levels also since the recession. So we are seeing progress on the job market. It's still not a strong labor market, but it is getting better, and I think that's what the confidence numbers are really showing.
Now, rising confidence, we cite this a lot, but is it a leading indicator or is it a lagging indicator? Because on the one hand, when the stock market does well, when the jobs numbers come in better than expected, confidence rises. Yet, in order for companies to actually go out and hire people, they need to have more confidence. There has to be confidence there first.
I think there's a distinction between the kind of consumer confidence surveys that we tend to track versus business confidence. Consumers, in my view, really don't respond a lot to the month-to-month changes in confidence. They really are consumer spending is fueled by job and income growth as well as what's happening in the stock market. Businesses, on the other hand, do respond very quickly when their confidence deteriorates. They will cut down on hiring quite quickly.
Right. You're talking there about the whole question of ask consumers what they do, not what they think, because what they actually do is a whole different story.
That's right. We certainly saw that this summer when confidence measures dropped, but consumer spending actually picked up as gasoline prices fell and there became more autos available after the Japan supply chain disruption eased. So that was a good example of where confidence deteriorated, but it didn't deter consumers from actually spending more.
Okay, talk about the link between confidence then and housing, because that remains kind of the weak link of the U.S. economy. A couple of housing sales numbers have shown some improvement, some signs of bottoming out, but then yesterday we had the S&P Case-Shiller Home Price Index, which showed a bigger than expected drop in home prices.
What I think we're seeing right now is a real divergence between areas that have a lot of foreclosures, that's putting downward pressure on house prices, and that's going to take a long time to work through. On the other hand, there are areas of the country that don't have massive foreclosure overhangs right now, and that's where you're seeing sales edge up just a bit. Prices in some areas are edging slightly higher, so you're really seeing a bifurcation there. Consumers are not in the mood to jump into housing, plus credit is not freely available, so we're not going to see a surge in housing soon, but we are starting to see some signs of moderate recovery.
So if some are projecting a bottom and we're seeing some signs of modest recovery through next year, is that feasible with the European sovereign debt crisis hanging over us?
We think that it is. There certainly are risks coming out of Europe, and I think the biggest single risk I would highlight is the risk of a financial crisis, similar to 2008. If that were to develop, then we wouldn't be immune to that by any means. However, if we're just talking about somewhat softer exports to Europe, it's not a huge part of the U.S. economy. It would be more of a headwind than something that stops the U.S. economy cold. So we do think that we can grow moderately even with the difficulties in Europe.
Okay, moving from housing to manufacturing, because that was one of the bright spots when the U.S. economy first began recovering, but it's lost a little bit of momentum. With the rest of the world kind of in the doldrums here, especially the emerging markets, how does manufacturing look for next year?
I think the really important driver of the manufacturing sector recovery of late has been consumer spending. So if consumers remain on a moderate growth track as they are right now, we think the manufacturing sector will continue to grow. Certainly the difficulties in Europe will be a headwind to that sector in particular, but we do think that the U.S. domestic demand will hold up reasonably well.
We're talking about the impact on U.S. consumer confidence, the impact from Europe, from the emerging markets. The consensus right now, heading into the new year, seems to be that Europe is headed for a mild recession and the U.S. may see a little bit of a dent on growth, but not too much. Is that too positive?
That is our view. We do think Europe is in recession right now, the euro area in particular. We think that'll last for much of the first half of 2012 as well. By the second half of the year, we think Europe can grow modestly. But on the U.S. side, we expect that growth will be 2.5% in 2012. So it's certainly not extremely strong growth, but it is enough to keep the economy moving.
How can Europe stay out of recession when it is implementing so many spending cuts at the same time?
Well, we do think that Europe is in recession right now. So and part of the reason is the fiscal tightening that's happening there. And that's a real divergence between what's happening in Europe and the U.S. The U.S., we do have some fiscal tightening happening, but it's not to the same extent as is the case in the euro area.
Okay, so if the U.S. is going to avoid getting slammed by a euro area recession, what about the slowdown that we're seeing in emerging markets? In places like Brazil, in places like China, who have signaled that they're concerned about things by cutting interest rates. When are we going to start to feel the effects of that?
Well, we already have to some extent. Our exports to China have slowed from their peak and to other emerging markets as well. I think when we step back, though, the emerging markets such as China, Brazil, they had been raising rates and trying to slow their economies down. They succeeded, and now they're a bit worried that maybe they've succeeded too much. But much of this was a policy-induced slowdown that's been layered onto by the slowdown in exports to Europe. We think that there will be some easing in emerging markets. There will be a moderate slowdown there, but not a hard landing, as some might fear.
All right. Thank you so much, Dean Maki, Chief U.S. Economist over at Barclays Capital, joining us on In Business.